Hey everyone, welcome to this week's stock and macro update. So this week I want to start off with a portfolio review. Then I want to get into Uber and just do a quick overview of them because they are one of our disruptors. That's kind of the disruptor of the week. And then I want to get into deflation. So we got the PPI last Friday and then the CPI earlier today. And I just want to get into what I saw in both of those, what we can expect going forward. So with the portfolio review, so real quick, just to run down of the portfolio, the disruptors index over the past week was down 5.71%. That's Monday to Monday, compared to the S&P 500, which was down 1.97%, NASDAQ down 2.38%, Russell 2000 down 3.85%, and ARKK, which is the growth proxy, down 7.47%. So the farther out you get on the risk curve, the growth curve, whatever you want to call it, it was a worse and worse week for the market. Growth stocks were hit hard. Even the S&P was down a couple percent. Then followed by like I said, Russell 2000 almost down 4%, ARKK down about 7.5%. So definitely a rough week for growth stocks. The one exception to that was DocuSign. So that was by far the leader in the 21 Disruptors Index. That was up about 16% for the week. And then number two out of the top three performers was Proto Labs, up about 1%, and then Bitcoin up about 0.5%. The bottom three performers, Guardant Health, down about 14.5%, Livent Corp, which is a lithium stock, down 14.5%, and Tesla down almost 14% for the week. So again, kind of a rough week for growth. Some of the commodity stocks like Livent also were hit kind of hard. But it's been a volatile time for the market, and growth really hasn't caught a break for a while now, other than DocuSign. That reaction to earnings was very good to see. So now I want to get into Uber. I think this is one of the most overlooked stocks in the entire market, so I'll start off with that. They are a company that I think is as recession-proof as anything you're going to find in the growth world. I think that they serve a need that a lot of people have, especially actually on both sides of their business. So for riders and also drivers. So in tough recessionary times, more people are going to be wanting to look for extra income. More people are going to sign up to be drivers. This is exactly what actually helped propel Uber in their early days. They were founded back in early 2009. So it's not like they were, some company that was able to get a bunch of easy funding in an environment where banks were just handing out money and VCs were looking for everything. They started out in one of the worst times in recent economic history, and they were able to succeed from there. And the economy didn't recover overnight. It was years of a pretty bad economy there, where Uber was able to grow and thrive in that kind of environment. And now we're seeing, kind of an oncoming recession. It's really mixed when you look at the indicators, but pretty much every leading indicator out there has been pointing downwards for months now. And Uber is still growing like crazy. They have showed really no signs of slowing. I believe they have record number of drivers, delivery drivers, and also customers as of October. So in their last earnings call, they said October was their strongest month in company history. So 2022 really hasn't done any damage to this company whatsoever from their core business. And you can see that in their sales. So if you look at just their revenue from the first 9 months of this year, it's already 33% higher than all of their sales from 2021. So, the sales just keep coming in. They're seeing margins actually get better this year, whereas a lot of companies are seeing margins contract and get worse. Uber still has negative operating margin, but they are very, very, very positive when it comes to free cash flow. So far this year, in the first 9 months at least, they've had $693 million in free cash flow. So, they have a ton of incoming cash that they use to continue to grow their business. They're now in, I believe, over 10,500 cities around the world and a ton of countries. They are pretty much everywhere, and they also have investments in other countries, in businesses that are kind of similar to theirs as well. So there are a few positive developments going forward for Uber that I just want to touch on real quick. First, they actually just started running ads on their apps this year, and they were able to, really create a very successful business with very high growth without any ad revenue, which again, not a lot of disruptors, companies in the kind of consumer economy, gig economy, not a lot of them can say that. And their ad business has already been a success, and we're not even a year into it yet. They're already at about a $400 million annualized rate of revenue for their ad business, and it looks like they're probably going to hit $1 billion in ad sales next year. So again, we're seeing companies like Facebook, Google really struggle in the ad area. Snapchat, Snap Inc. is another one where they are really struggling with ads, and that has really hurt their stock price and hurt their revenue growth. And Uber really isn't feeling any of that pain. And I think that the gig economy is really a lot stronger than people want to give it credit for. People see it as some niche thing that's just on the side, when in reality, this is a way for a lot of people to earn some extra money in a tough time where we're having inflation and really weakening conditions of the general economy. People are going to be flocking to these kind of services. That's why Airbnb, which I went over last week, is so strong. That's why Uber is at the strongest point in company history right now, despite a rough year. So I just wanted to touch on them because, again, I think this is one of the most overlooked companies in the entire stock market. Sure, they're not profitable. A lot of that is actually because their investments and unrealized losses actually on their investments is negative, and that is a expense on their income statement. So it's a lot of that unprofitability that you hear people love to talk about, and you see in every headline about Uber, is due to just a technicality with accounting standards. So really, I wouldn't count this one out at all. That's why it's in the Disruptors Index as part of the gig economy kind of sector of the index, where we have Airbnb, Uber, and Pinterest. So next week, I will round out the sector with a overview of Pinterest. Now I want to get into deflation. So we had the PPI, Producer Price Index, come out last week, and it was a little higher than expected. I think that kind of scared people a little bit, but the PPI is still coming down pretty strong. And I think it was 7.3 or 7.4% year over year. It was well into the double-digit range earlier this year, so it is down quite a bit from there. And we're actually seeing now signs of deflation in the PPI. So like the title suggests, the PPI, Producer Price Index, measures the cost that companies incur on what they're selling to the general public. So it measures the costs really across the supply chain. And for goods, it actually measures 5 different areas of the supply chain. So from basically the initial standpoint where you have natural resources, all the way to the finalized sale to the end consumer, which is you and me. Those are all accounted for in the PPI. And that is really just for goods. Obviously with services, there's really not much of a supply chain. But I just want to run down the different stages of the supply chain where we are seeing deflation. So in November, and this is month over month numbers, Stage 1, which is the earliest stage of the supply chain, was down 1.2%. So costs dropped 1.2% in the earliest stage of the supply chain in November. Stage 2, costs went down 3.4%. And both of those stages, 4 out of the past 5 months, have been deflationary. Stage 3, 0.9% decrease in cost, so deflation. And that was the 5th straight month with deflation for Stage 3. Stage 4, costs were down 0.3% in November, and 3 out of the past 5 months have been negative. And then we had the final demand, which is the kind of the endpoint sale. Costs of that were actually up 0.1% in November, and 2 out of the past 5 months have been negative. So towards the end there, Stage 4 and final demand, there hasn't been as consistent deflation, but earlier in the supply chain, there is very consistent and large deflation. So it's still working its way through the supply chain. And again, that is for goods, not services. And so we're seeing that deflation work its way through the supply chain. And I think that's going to show up in the CPI sooner rather than later. And I think that we actually saw some of that here in the CPI report that came out earlier today. So energy, that's also a component of the PPI as well as the CPI that's coming up on very high year-over-year comparable prices. So for November, energy was down month over month, I think for the fifth straight month in the CPI and PPI. But the overall kind of energy index, and it's not like the oil price or natural gas price, the PPI and CPI each have indices for each kind of component. So they assign an overall price for an index for energy, for goods, for services, and so on. And the energy index price for November was the lowest price for any month since February. So now we are getting to a very close point where we're going to be seeing those year-over-year numbers come down. And that's really important because inflation for energy and PPI year-over-year is still 13%. But even if energy prices stay flat over the next couple months, that number is going to go from 13% down to negative prices, because once March hits, the overall year-over-year change is going to be negative, assuming that the current prices stay the same. So switching to CPI now, commodities, this is the kind of like non-energy, non-metal commodities, which is a bunch of consumer goods. And this is a kind of similar to the goods portion of the PPI that I touched on, but that portion of the CPI is down 5% month over month in November. So that was really good to see, because that has been kind of one of the slowly deteriorating parts of CPI, but this was the most negative that has been in quite a while. So that is good from a good standpoint for CPI. And as we go through the first quarter of 2023, again, goods are going to turn deflationary, and that's kind of led by used cars. I'm sure you've heard many times by now that the price of used cars is now negative year over year by about 3.3%, I believe, in CPI. But you'd think that used cars would be a big part of CPI, because when you think inflation, a lot of people think real estate and cars, since those are the two biggest purchases that people make for the most part. But used cars are only about 4% of total CPI. So used cars does not make a trend, but it is a good trend when you're looking at overall goods. And now we're seeing the overall goods part of CPI, which is about 21% of total CPI. That's starting to move down month over month, and then that is going to change over time to year over year. And that, again, energy, same thing as PPI. So for CPI, the energy index price was the lowest since February. So in the next few months, we should see energy inflation drastically reduce if energy doesn't, go on another tear, which for now it looks like it's not going to. It really depends on the whole supply-demand conditions. I know that OPEC doesn't want to increase their supply. They want to cut it, so we'll see what happens there. But if energy prices stay anywhere close to where they are now, we're looking at deflation in energy in CPI and in PPI within 3 or 4 months from now. The areas where we are still seeing sticky inflation are services and food. So real estate, which is calculated really poorly in the CPI, and by poorly I mean that even in 2008, 2009, there was no decrease, there was no deflation in the real estate part of CPI. So this isn't a number that is by any means accurate in my opinion, but we still have to go with it because that is the biggest part of CPI. It's about 32% of CPI. So that has been a very sticky part. That was up, I think, 0.6 or 0.7% in November. Food is another area that was up, or that's over the past year, that's still up 14%. I think that was up around 0.5% in November. Between those two, that's like 45% of CPI versus commodities or non-energy commodities and energy, which combined I think is around 30%, and that's what we're headed towards deflation in. So we've got kind of these areas of CPI kind of fighting with one another and pulling each other in the opposite direction. But overall, I think CPI is going to continue to stabilize. It was 7.1% year over year in November, and I think we're going to continue to see that go down as we see deflation go into goods and into energy. So that is it for this week. Definitely let me know if you have any questions or comments in below, and I will see everybody next week. Thank you so much for watching.